Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to have another discussion with another person in the space. We had a video the other day with PlanB, who is famously known for the stock to flow and stock to flow cross asset models. There was someone that was brought up a couple times during that interview, Dave the Wave, and so I thought, what better thing to do than just bring him on the show and show us a different perspective to the market. So remember, having more than one perspective, in my opinion, is key to successfully navigating the cryptocurrency asset class. So Dave has a fairly popular Twitter page as well. We will link that down below. I would encourage you guys to go follow him. But yeah, Dave, it's a pleasure to have you on the show. I'm happy that you've agreed to come and show your perspective on Bitcoin.
Yeah, g'day Ben. Yep, all good. I enjoyed your video the other day with PlanB, and I thought doing a follow-up video, maybe discussing my ideas a bit better in the context of your guys' ideas would be a good way to go.
Yeah, so there's all sorts of theories floating around the crypto space, and I always find it fascinating to find various models. Sometimes they differ by a lot. Sometimes they're not that different. But could you walk the audience through what you see in the market? Like, what do you see happening? Where is Bitcoin for you? And just give me your general thoughts on that.
Yeah, I think when it comes to models, you'll find various people are going to come up with their models, but they are based on, I think, a lot of the time they're based on different paradigms. I know that's a bit of a buzzword, but we all have some sort of conceptual apparatus by which we interpret things, right? And I know you maybe favour the quant side of things, the math side of things, which is great, and I think maths and the technicals are really good. But my focus is a lot of it is on the macro ideas, macro concepts, which is a little bit more qualitative in contrast to quantitative thinking. So we have our different models, and they're based on different paradigms, and often they can appear unintelligible to each other, and yet there's room for a conversation among them. I've got sort of Thomas Kuhn in mind here with his idea of paradigms, but that's first and foremost before you even start getting into models and how they can be different and yet at the same time a little bit similar.
Right. Yeah. So where do you, with your qualitative view of the market and this macro outlook for Bitcoin, what are you thinking right now?
Okay, you can see my screen?
Yep.
Yep. All right. So the main idea that I've had for quite some time is the LGC, what I call a logarithmic growth curve. It's slightly different to log regression, and I was looking at log regression a bit earlier, which interestingly PlanB was also looking at. If I, something like this.
Right.
Where that line was a mean, and the tendency was this line would keep coming down, right, as the market developed. And I got to, I think, just before this crash we had here, right, I was very much looking at this blue line as a mean, right? I hadn't really thought of lowering this line further down as more of a technical support for the price. But after this crash here, where we went from 6 to down to 3, the 3K range, it just hit me that, well, actually, this could be all redrawn and into a log LGC. Now, the fundamental concept, like I mentioned concepts before, because the LGC is primarily a concept, right? A logarithmic growth curve is something that plateaus. You get explosive moves at the beginning, right? Exponential explosive moves, and then this thing plateaus eventually. So it kind of has to be, in my mind, it has to plateau out at the top here. And I've got that plateau between 500k to 1,000,000k, right? The numbers get pretty big in here, and yet in a geometric or logarithmic sense, it's not that much up here. So, yeah, the LGC is pretty fundamental there. Now, I noticed people around this time here, people started thinking about an indicator, using an indicator or LGC, and I've got that here. Now, so there was this indicator drawn, and I think this came out before the second capitulation event, right?
Right.
And I've actually got well, I did have a tweak for that. Let me get rid of this. So, this is going back in March last year, over a year ago, right? And, I thought, as soon as I saw this, I thought this is not a logarithmic growth curve. First, it seemed pretty high for the curves that I'd drawn, and I suspected, well, it's drawn too high. And sure enough, I said at the time, no wiggle room to the downside, and it doesn't plateau, as a log growth curve should do. So, going back to this chart, you can see that, really it closed beneath it. And when price bounced back up, I think this took us all, well, most of us by surprise here. It fell well short of this indicator.
What did it have it at? Like 100K? Is that where it had it at?
And it's got it, yeah.
Around 100.
It's got it at 100K.
That would have been 100K though back in April or May.
Let's have a look. I've got the here. Yeah, 100K, bang on 100K. My LGC, it was a bit lower, 70, 80K. So, price fell pretty much went from, in the LGC, the price never closed below it. And price went right to the top of this channel. Pretty much. It didn't quite touch the top, but pretty close, right? A lot closer than this indicator. Now, the other problem with this indicator is I call it the curve to nowhere, right? See that? It doesn't plateau out. These lines are all over the place. Mm-hmm. And so, so you can see the attempt to draw a formula for it. But see, what I've tended to do is with this LGC, let's get rid of this one, is I've just hand drawn it, right? And that could be seem a bit crude, but what we're dealing with, I think, here is a geometry. So, the logarithmic scale that most of us are familiar with, right? is also, this is all about geometric values. So you can, a lot of my TA is geometry. It's a spatial measurement of this y-axis, which is increasing logarithmically, right? And so, you know, you can use the tool to if it's taken out far enough, to draw this curve, hand-drawn, drawn the tops of them, they all plateau out. The essential point here is this convergence at the top, right? And I think that's something you've got on your charts too, Ben, right? You see that channel is converging.
Yeah, they do end up converging a couple decades from now.
Right. Yeah. I don't know if you have it plateauing like this, and I've got a macro explanation for that.
Well,
because,
sorry, go ahead.
You know, yeah. The idea behind this is, you know, back in the day they were talking about price discovery, right? Price stabilization, store of value, right? So that's pretty much what I have in mind here, that you've got this nascent currency, this new currency that's just come onto the block, so to speak, new kid on the block, and it's in the process of capitalization, becoming a currency. So, you know, this market cap here could be somewhere in the up there with gold, right? Maybe even a bit north of gold. But, you know, whereas gold, that's been capitalized for thousands of years, this thing is being rapidly capitalized and over 2 decades, 2 decades, right? 3 decades. Now, the parallel here, right, for logarithmic growth is new technologies. So a lot of people talk about the S-curve, right? We're all familiar with the S-curve. Mm-hmm. You have explosive uptake of technology, and then it plateaus out. Now, the S-curve it's the same thing. The S-curve is the log curve, right, but on a different scale. So the S-curve is on a linear scale. We have 0 at the bottom and 100% at the top, right? Now, logarithmic, so you've got the S-curve, you get this vertical rise, and then it tapers off at the top as you have mass adoption. If you put that on the S-curve on a logarithmic scale, on this scale here, on the log scale, right, there's linear, that's linear. So this thing here is just taken off. And, you know, what are we thinking, 500,000? 1 million? It'll do something like that.
Okay, so right? It looks like on your chart, are you, is the idea that it'll ultimately become fairly stable between 500K to $1 million?
Yeah. And, you know, in a linear sense, it won't. It will be still volatile, like a stock market or any asset might be volatile. But in a log sense, right, in this sense, by zooming out, this will be relatively stable compared to this. Like, you know, you talk about a lot about returns, ROI, right, and diminishing returns. So the returns up here are going to be a lot less than what we've seen here. And I've mentioned the S-curve really more just to give an example of logarithmic growth. So new technologies give you logarithmic growth, explosive growth at the beginning that tapers out, plateaus at the top. And I think, I could be wrong, but my model is lined up with that it plateaus out at the top. You know, and this is something you're quite familiar with, the diminishing returns idea, right?
Right.
That as time progresses, you know, those returns are going to become less and less.
Yeah, I mean, I think that's. I mean, I think it's pretty obvious. It's you know, it's an unfortunate consequence, right, of the market. But again, if we weren't experiencing diminishing returns and we were putting in the returns that Bitcoin saw from the first couple of cycles, then Bitcoin would already be over $1 million. You know,
Yep.
I think that there's a lot of people hoping that we don't have diminishing returns as measured from the last cycle, right? Which would mean
Yeah.
we still go to 300K this cycle, I think is sort of what they're saying. But that actually brings me to another question I have for you.
Yep.
Now, looking at your chart, I see that every time it hits the upper logarithmic growth curve boundary, you have sort of a downward sloping line,
Yeah.
taking it back down to the bottom. Are you speculating that Bitcoin needs to go back down to the bottom before it can go back up to the top, or do you think it doesn't matter and it's more so it just needs to stay between the bounds?
Okay, now that's a really good question, because I was going to talk about that next. Was an important distinction has to be drawn here, right? I'm wearing different hats. So today primarily I'm wearing my modeler's hat, right? And when I'm talking about the LGC model, yeah, I'm talking about the long term. And so as far as, I'm not too concerned about these massive divergences or moves off the mean. I'm kind of more concerned with this channel here, right? And I think, along with yourself and PlanB, I'm probably kind of more concerned in a way with this mean price staying in here. So that's a similarity, but the differences, of course, would be if price moved above this. If price carried on here, it did a 10x and it does another 10x or whatever up here, this would be invalidated, right? So the model is this. This, let's get rid of that. Oh, well, goodness me, let's just, if the focus becomes this instead, right, what you have just mentioned, right?
Right.
Then I'm wearing my TA hat, medium term TA. Now the medium term TA, the nature of TA is it's fallible, and well, everything's fallible, right? But the medium term is less probable than the longer term, right? So medium term TA, I consider I third expect it to be wrong. Short term TA, I half expect it to be wrong, right? Short term, we're talking about probabilities. Probabilities, you're talking about qualitative thought, I think. It's hard to quantify these things, right? So in shorthand, I would say short-term TA, half expected to be wrong. You're basically gambling. So I don't do day trading, and sure, why not have a bash at it, but don't put all your money into day trading where you're going to get wrecked. You might as well go to a casino. Short-term TA, half expected to be wrong. It's interesting. Do a bit. Medium-term TA, the odds are more in your favour, right? So I will do a lot of medium-term TA. And I third expect it to be wrong, right? Long-term, and long-term's the model, I quarter expect this to be wrong. So that's the way I'd phrase it. So I'm hedged every which way, right? I'm hedged because there's no certainties. And everything is based, some people are looking for certainty, and that's a natural desire. But I think it's more rational to just recognise, well, the future's uncertain, and that's your basic building platform, and on top of the uncertainty principle, you start developing your models and your TA and whatnot. And so there's lots of hedging going on within that. And I consider uncertainty actually a virtue of the system. Um, but it's not anything goes. It's like, well, like this LGC, I'm pretty confident in it. But I think confidence is the good word, right? Is you can have confidence in something, but you don't think it's a sure bet. So coming back to your question there, Ben, that is this is medium-term TA. The LGC model price, yes, just has to stay within here. So it could do, like you're talking about the lengthening cycle, right? So we both agree on DR, right? But whether or not you've got a lengthening cycle in here, that's an interesting question, and people might have different views on that. But if price went up here, it's fine for the long-term model as long as it didn't go north of 100k, right? If price goes down, it's fine. It's within this these parameters. It's fine. If price goes up here, my medium-term TA is kaput, which I expect to be wrong anyway, and that's why I trade alts, because on the alts I tend to be a bit more bullish, which is a hedging strategy, and which I call that negative capability. You're juggling a few different balls. The last thing you want is one hermetically sealed system of certainty, right? I'm very much, as a trader, very much interested in playing the odds.
So you would say long term, which is what you're most confident about, we will stay within the channel, in the logarithmic growth channel. Short term, it's more or less a wash because it's really hard to predict short term moves, like what's going to happen tomorrow. No one really knows. But medium term, you hedge your bets by figuring out what you think Bitcoin is going to do, but you're not necessarily trading your Bitcoin, you're trading your altcoins, and you trade them based on how you feel Bitcoin will perform.
That's right. And the alts are more volatile against USD.
Okay.
All right. And a lot of people want to trade their alts against Bitcoin, but if you're going to be fully hedged and you're long your Bitcoin and you're long a few major alts, then you're wanting to trade the volatility, because the alts are more volatile, and the natural partner is USD, right? It's more volatile against USD, and you're taking profits in USD. So you're fully hedged, and you're counterbalancing your long positions.
So what would you say your outlook is for like the rest of 2021 and maybe 2022 and 2023? Like, do you have sort of like a medium term? I know that's not necessarily the macro scale, because I think when you talk about the macro scale, you're talking about the next couple of decades. But with the medium term, let's say, the next, like through the end of the year, going into the next couple of years, what are your thoughts on the market?
Oh, so we're getting we're moving away from the model now into TA, right? Medium-term TA. Would you agree?
Right. Yeah. I think. Yeah. So you have your logarithmic growth curves, right? And we generally, so you're saying you would generally expect it to stay within those bounds no matter what. In terms of, it doesn't really matter if it breaks a downtrend or not. It's just going to stay within these curves, and anything further than that is just, technical analysis, which is more subject to being inaccurate, right? Yeah.
Yeah, and I think that that's an interesting. So I draw the distinction between the long term and the medium term. Now, what I think we're talking about here is cycle theory, right? And I wrote an article about this a while back. And I've way back, and when's this, 2018? Yeah, 2018, end of 2018. I was actually looking at lengthening cycle, right? Um, and lengthening cycle, diminishing returns, and I was, yeah, it's all good, and I've seen you using this a lot also, and it's the idea's there, and I kind of started wondering about it because I wrote an article here, Cycle Theory Revisited, at the beginning of the year. So I kind of started finding this idea a little bit problematic, because we had this nice cycle, right? And then we had this move up, and I was like saying, oh, come on, I'm worried about this, guys. I think this is taking off too fast. And I think we were kind of on the same page there, right? Mm-hmm. You saw it's all taking off a bit fast too. And that was fine. That was like, okay, maybe that's an anomaly. And sure enough, it came back to the curve, right? And that was all fine. And actually, I've got something here looking at that, just an explanation. Price got overheated. Spelling mistake. Too quick a departure from the base, and then bottom and again the buy zone. So this has always been the buy zone. Like, people think I'm a bear, but actually it's very bullish. It depends on your time frame, right? Buy, and buy in here. Plenty of time for buying, but It's human nature. We buy the tops. I saw price getting overheated on the parabola because this was a parabolic rise. I'd much rather just see it chug, and there's a nice cycle up again, but it doesn't work that way. Markets, and markets are not efficient. Efficient market hypothesis. See, that's where you, myself, and PlanB all agree. I think we all think they're super speculative markets, right?
Right.
They all take off on us, and so these are kind of outliers in a way, these peaks and these dips. But I'm interested on the medium term in that, because if I can trade that to my advantage, I'm going to, right? Because I don't have a certainty about where everything's heading. So hey, why not hedge your bets? But see, here I called it earlier. I said, oh, this is going to correct, guys. But, it kept taking off and went right up to the channel. But sure enough, it's coming off again. And the prediction here is support at the buy zone. I don't know if it'll go deep into the buy zone. I'm kind of thinking low 20Ks. But that's a TA call, right? Because I'm looking at this parabolic rise and a solid correction of that. And I use fib levels and TA. It could be wrong, but it could be right. The jury's still out on that one. So back to where we were. So, when this took off again, I thought, well, hello, that's interesting. This before was an anomaly, but it's happened again, right? And I thought, well, this cycle, if it's a cycle, is certainly irregular compared to this one. This was all nice and neat. And actually, this one back here was quite irregular, right? And sure, you can start comparing this to what's going on here. But and you could call this an extended, a lengthening cycle, right? But my problem with that, if I go back to the chart, is it all starts getting a little bit, if we're talking about lengthening cycles, so we've got, what's that, a 4-year cycle? And they can be measured from base to base or peak to peak. Doesn't really matter, right? Because the corrections are usually a year. But say we put our cycle, where's the peak, do you think, of the, out here, right? End of 2022, right? So
I mean, it ultimately. I mean, I don't know where it's going to peak right now, but I mean, I know obviously it ranges from some people thinking it's going to peak next month to to people thinking that we're in the middle of a super cycle and we're not going to go back down.
Yeah. No, but just for argument's sake, to talk about a lengthening cycle, so we go from, say, we've had 4-year cycles, say a 5-year cycle, right? It seems pretty reasonable.
Yeah.
We could do that. We could find support here and take off again and get a double top or a higher top at the, go up to, whatever. So it's 5, this is about 5 years, right? Now, if it's a lengthening cycle theory, so if you're talking about that in a macro sense, like lengthening cycle and diminishing returns in the same sentence, then the thing is, what do we get after that? Is it going to be a 6-year cycle? And then after that, is it going to be see the problem?
Well, I think
starts getting a little,
I think the problem is, and I've mentioned this a couple times before, but that's a fair point. Like at some point, also you could argue that the cycle length is somewhat subjective, right? Based on where do you measure it from, and there can always be some subjectivity in where you measure it from. And and if you have increasingly irregular moves like we had this cycle, imagine the 2019, or like say, I guess, imagine in 2020 when we capitulated to 3,800, imagine if we had actually gone below 3,100 and put in another bottom, then that would have completely changed things, know, and it's not that hard to have imagined that it could have dumped another $800, So
that's right. It was just a big wick down. Yeah.
Right. So you're basically saying, you know what, like why don't we stop calling it a certain, length of cycle and just say, hey, we're going to have these moves, and what's more important is we're going to have logarithmic growth and diminishing returns within that.
I'm thinking I'm thinking it's going to be increasingly regular, and the concept, and I come back to a macro concept here that I started with at the beginning of this talk, is that the macro idea is that an increasingly liquid market, an increasingly mature market, is going to be less volatile. In the sense of cycles, these big huge cycles. So it's going to break up, I think. And so what we could be seeing here is a breaking up of these grand cycles that we saw, where this market was quite, it's a new market, immature market, less liquid. You had this huge move up, and now it's breaking up into what I call little boom and bust cycles, so to speak, right? Or speculative episodes. So here you get this move and then correction, a move and a correction, and it's going to be something messier. I'm thinking, who knows, right?
It's like a ping pong ball going back and forth.
Yeah. Whoops, that one went backwards. But yeah, exactly. So it's sort of it's going to become a lot messier than it was earlier. And then this one here, sure, you could say, well, that was a lengthened cycle, even if it comes back to 20K and does, and actually in the midterm, I think it might do this. Come back to, I don't say 20K, so the low 20K range, but because 20K is pretty low, so I try to keep it the low 20K range, right? Could come back here and then go on another runner, and technically you could say, yeah, well, that was a lengthened cycle, but the likelihood, see what I mean? It's gonna become a lot choppier.
Right.
In here.
Well, I think. Sorry, I was just going to comment. I would say that it probably depends on what it does. First of all, there's if it goes back to those levels and then it just goes sideways in that bottom channel for a couple years, then we could look back and say, well, the cycle was actually shorter than the prior cycle. But
Yeah,
yeah,
yeah.
I mean,
It could go either way. Yeah.
would you say that there's, I mean, would you say that, because we already went down to like, the 28 to 29K range. You think there's a possibility that that was the bottom, like that was sort of like the shakeout that we needed to push to 100K, or do you think?
Oh, okay. Yep. So now we're getting into TA, right?
Yeah.
Like sort
Yeah,
of
well,
the more
I'm just, yeah,
medium term.
everyone wants to know, these opinions and whatnot.
Fair enough too, and I got no problem with, well, when I start doing TA, I mean, I'm not concerned about it being invalidated because the medium term TA can be invalidated. That's fine. It's not my model. It's the
Right.
LGC that's sort of like my precious, so to speak, right?
The
It's the
only,
model that I'll would see work out. But yeah, I mean, yeah, why not look at that? Now, okay, let's get rid of that. These cycles. And so I've got rid of cycles out of my mind altogether now.
right.
Whereas when it comes to medium term, right? And I just love the simplicity of this chart, right? So we've got the 1 year moving average here. And interestingly, that is meeting right on this bisection of the LGC, right? So let's emphasize that. And you've got this parallel going on, and hey, look, it even went north of this line here. Took a while to roll over. And, the thing is with medium-term TA, it takes time to play out, to be validated or invalidated. It takes time. So I won't really know for a month
Right.
or so if this plays out, right? It could, crikey, who knows? So that's a rounded top. Whereas and this is the explanation I have for that, is it's a more mature market. Maybe we're not going to see these things again.
That was what everyone was looking for too.
That's right. There's no blow off top, right?
Yeah.
Everyone was looking for that. And so it's rounded. And if it did blow off, it probably might have hit the top of that channel there, right? Which is only, like yourself, I trust this line less than I trust this one, because this is where all your data points are.
Right.
But this is yet to play out. I think it's, I 2/3 expect it to come off. Now I've been pretty bullish on the alts. Anyone following me on the alts page sees me. I've been buying the dips and establishing positions for the longer term. And yet on Bitcoin, I'm talking about this correction. And once again, that's wearing different hats. So, it takes time to play out, and there's a lot of different factors involved in this, because this could correct back down here and, do something like it did in here, right? And then you could see a final washout. And I was looking at this right from day one. I was predicting this would roll over, and the natural parallel is these. But, it's funny because we look at the number, and when I look at the low 20K range, say it came down to, it did eventually, I'm thinking 1 year correction. 1 year, this year, corrective year, right? Say it comes down on a capitulation, and here, it's still a pretty good price, but it's human nature, we have these peak prices fixed in our mind, right? Mm-hmm. Rather than the average, the mean price, which really is this 1 year average, right? And it was down here for quite a while. These were all very good prices. And, it's stayed up for a while, but yeah, that's my main view, that it's going to come off I don't think it'll go deep in here. I think just like the same as you didn't see the blow off top, right? I doubt you're going to see, you know, it's such a capitulation. And that, I think, you know,
Right.
I think that is due to an increasingly liquid market. So this rounded top here could be reflected in a rounded, maybe a capitulation from this level down, rounds out. I'm speculating here, right?
Right.
And then it could take off. It could take off again because no one expected this, and then no one expected this again so high. So it could come down, and then take off again. And I wouldn't be surprised to see 2022 a really good year and getting our 100K next year.
So you would speculate that 100K is more likely to happen in 2022 than it would be to happen in, say, 2021?
Totally. I would be very surprised, and you know, it could spike.
Yeah, I mean, even the logarithmic growth curve that you have sort of seems like it would theoretically allow for around 100K. Like if it went to, like, by the end of the year, if it went to 100K, it would still be more or less constrained in the model. Is that correct? We're getting it pretty close.
Well, I think it would be, you know, it's getting up there, right? Like if we look at, you know, draw a, you know, at the end of the year, what's that, right? You know, if it went up to 100K, that would be, it's getting up there.
Right. It'd be right about there.
Yeah, I mean, if it was a spike and then come off, no problem.
Right.
But if it was what's the likelihood of that? If it went up there, it would, say price did this, it would probably go bump, right? And then who knows? It would break this curve. It would break the LGC. Right. So I would say, I would say 100K by December. The LGC is very much at risk of invalidation, right? Unless it corrected pretty quickly, just as my medium term here is at risk of invalidation. It just takes a bit more time. This takes a few weeks. That would take a few months to completely invalidate it. This here to, like at the moment, this is being tested, but it was tested back here. That's what you expect. You expect it to be tested.
Yeah,
so
I mean, all
LGC
models
was tested here.
All models are constantly getting tested right now. I think.
And that's the strength of the model. You want to have like a crucial test, because that kind of confirms it. Shows how robust it is. It's tested, and you get the confirmation. So you know this needs to. If the price over the next few weeks, did a double top, then my medium term TA, that's invalidated. That's okay. It's TA. It's not bloody. It's not bloody. It's not a dogma. There's no certainties with it. Even though the probability is, I think it's likely, it can be invalidated at the same time. But just as that needs a little bit of time to be invalidated, the same thing would be involved with 100K in December. But yeah, it's pretty unlikely. And if I would be prepared. I'd throw the towel in if price was north of 100K this year for sure.
Would you say you mentioned that you've been with altcoins and whatnot, you're fairly bullish on them. If you think that Bitcoin is more or less due for a correction, say through the end of the year, would you are you sort of concerned about that, or are you buying altcoins as a hedge against Bitcoin just going up? and making sure you're buying those more volatile assets to to sort of cash in on that, or are you sort of just playing the altcoins as more of like a short-term play during this move by Bitcoin?
Oh yeah. Uh, yeah, I did have something about that.
Because I mean, normally we would expect, like, if Bitcoin were to drop, like, we would probably, I mean, altcoins would probably drop a lot harder.
Yeah, well, this is the alt trading is a pure play on volatility, and it's a hedge, right? And so when I do my Bitcoin charts and my long-term Bitcoin charts, I'm wearing one hat, and when I'm trading the alts, I'm wearing another hat because I'm hedged. It's like, I call that negative capability, right? And I'm more interested, the next certain thing, besides the LGC, the next certain thing is volatility, right?
Mm-hmm.
And so it's a pure play on volatility. So I call this the Christmas cake, or the layered approach. Bottom layer, you want to have some assets, cash, health, basic stuff, employment, whatever, right? Good life, healthy life. And then we're all invested in Bitcoin, core Bitcoin, hopefully at lower levels. So I consider myself a maximalist light, but I prefer the word centrist because I'm not a maximalist. So I'd hold a core in Bitcoin, right? And then on top of that, I'd hold a few major alts for the longer term. And by long term, I mean until the next manic market, right? Could be a couple of years away, a year or two. And I'll be selling most of that, right? I might even sell a bit of Bitcoin, right? Because the whole point of all of this is to realize real wealth, right? To make profits and put them into real assets and level up in terms of your real worth, not just digits on the screen, right? And then on top of that, right, so there's a few layers going on here. On top of that, I'm swing trading the more volatile alts for USD. So I'm wearing a different hat again. So here I'm a USD bull. And so recently, this year, people, it's only after the event that people started saying, well, was that a bull market? Was that an alt season? Right? And then prices, start coming off or taking off. But I got on quite low and I sold a lot, And so this was quite a lucrative trade here. And I've also, I distinguish, I'm giving away some of my trade secrets here, but I distinguish between the position longer term hold, right, and the shorter term swing trade, position trade. Right? Now, that's not day trading, that's multi-month swing trading. I'm getting a bit of feedback here. And then on top of that is leveraged day trading if you must.
Okay.
I mean, that's fine, a little bit on top of these, but if that's your main layer, I'm getting some feedback here, Ben, on the volume.
Oh, are you? It sounds fine on my end right now.
Right. No, it's not too bad. So it's complexity, isn't it? It's not, a lot of people are looking for simplicity, but if you're trading, there's complexities involved here. I compare it to someone juggling on a tightrope. Right, so you're walking across a tightrope, you got pitfalls on both sides, and you're juggling a few different balls. That's the life of a trader / investor. You can't reduce everything down to some simple model. or even if you have a model, or some fundamentals, right? It's you got to be a little bit more flexible than that. So yeah, that's my approach on the alts.
Okay, yeah, thanks for sharing. Well, we've talked about cycle theory, we've talked or lack thereof, right? Diminishing returns, the logarithmic growth channel or logarithmic growth curves. Is there, I appreciate you coming on today. Is there any last charts or words you would like to say to the audience?
I think we've pretty much covered it. What have I got up here? Yeah, I'll maybe finish up with going back to the LGC, right, to the model, because I mean that's our focus, isn't it? Focusing on the longer term models. We all want to know what price will do today, tomorrow, by the end of the year. But if we're investors or longer term traders, it's the models that are of primary importance. But I found that interesting, like listening to you and PlanB talk the other day, that I think a lot of us were looking at this logarithmic regression, and how no, it's not going to work. With price coming down here, this mean was too high, and so this has tended to be, we drag this down. The trend lines are unsustainable. The multi-year trend lines, they get broken all the time. And bringing this. Oh yeah, I'm getting bad feedback here, Ben. I don't know if I can carry on. Okay. But bringing that LGC mean down to support is the crucial aspect. So finishing up the curve, that, so it's sort of like you've got a combination of them. Oh, look, I can't even talk. I'm getting feedback now.
Okay. Well, I mean, I think we've gotten the general idea behind the model, the logarithmic growth model, and your thoughts more or less like medium term on what you're sort of expecting. But that again is different than the more macro model that you showed. But I mean, it was I really wanted to bring you on the channel again because you were mentioned on the interview I did with PlanB, so I thought a lot of people would like to hear a different model, and so I do appreciate you coming on the show and presenting it. Again, if you guys are watching this, go check out Dave the Wave on Twitter. We will link his Twitter page in the description below. Okay, so make sure you guys go check him out. It was a pleasure to have you on, Dave, and I will. I'm sure I'll talk to you again very soon.
Okay, thanks a lot, Ben. If you want to check me out on Twitter, easy enough to find. You can, if you go into my profile, you find my newsletter and information about the alts page also. All right, cheers for that.
Bye.
Bye.